Something changed on Monday night, and by Tuesday morning, nobody in the precious metals industry could explain it. The phones stopped ringing, not because people stopped calling. The phones stopped ringing because the lines were completely jammed. Every major dealer in this country tried to restock overnight. They pulled every contact they had. They made every call they could. And by Tuesday morning, they had something. A little bit. Enough to put back on the shelf. Enough to show in stock on their website. And within 4 hours, every single ounce was gone. Again, for the second day in a row. So if you've been sitting on the sidelines watching silver and wondering if the moment is here, pay very close attention to what I'm about to break down, because this is not a normal market event. This is something else entirely. And before we get into all of that, real quick, if this kind of deep breakdown is the type of content that matters to you, hit that subscribe button right now. We do this kind of thorough, no-fluff analysis regularly here on Element Axis, and if you're not already subscribed, you're going to miss the next one. So take 2 seconds, subscribe, and then we'll get right into it. All right, let's start with the basics, because context matters here. Over the last several weeks, physical silver demand across the major retail dealers in this country has surged by an extraordinary margin. We are talking about demand running at roughly 2.5 times what would normally be considered a busy week. Not double, 2.5 times the standard flow of silver moving from dealers to buyers. And the supply side, the refineries, the minting facilities, the wholesalers, they have not tripled their output. They have not even meaningfully increased it. They are running at essentially the same pace they were running 2 months ago. The demand side has gone from 100 to 250. That gap between what buyers want and what the system can actually deliver is enormous, and it has been growing wider every single day. Now, to understand how we got here, you have to go back about 60 days, because this did not happen on Monday. The pressure started building around mid-December. Dealers started noticing it first. Orders were coming in faster. Inventory was turning over quicker. It was busy, unusually busy. But it was manageable at first. Dealers hired more staff. They tightened their supply chains. One of the larger online dealers in the country hired over 50 new employees between Christmas and late January. 50 people. That is not a normal seasonal bump. That is a company scrambling to keep pace with something accelerating faster than they could staff up for. And even with all of that extra manpower, their shipping timelines, which normally run about 1 to 2 business days, stretched out to nearly 10 days at the worst point. 10 days, 5 times the usual wait. And that was before Monday. So here's the thing that matters. By the time Monday arrived, the supply chain was already at full capacity. The refineries were backlogged, the mints were behind on orders, the wholesalers were stretched thin. No slack left, no reserve. And then something happened on Friday that changed the psychology of the entire market. Silver had run from the low 70s up past $120 an ounce over the course of January. A lot of people had been watching and deciding to wait for a pullback. And then on Friday, the price dropped hard. Over Friday and Monday combined, the paper price fell by a massive percentage from its highs. And every person who had been on the sidelines waiting for that pullback rushed in at the same time. Not spread out over a week, all at once. A synchronized surge of buyers hitting a supply chain with absolutely zero remaining capacity to absorb them. Monday cleared the shelves. Tuesday proved they could not be refilled fast enough to matter. Let me put that Tuesday morning sequence into perspective, because the speed of it is what tells you something serious is happening. Several dealers managed to get some inventory back overnight. They reached out to wholesalers, to private sellers, to anyone with physical silver available. By Tuesday morning, some of them had product back on their websites, enough to show as in stock. Enough that a buyer checking the site at 7 or 8 in the morning could place an order. And by around 10, the new inventory was already disappearing. Orders were flooding in faster than websites could process them. By noon, everything that had been restocked overnight was gone, not gradually sold through over the course of the day, gone in 4 hours. That is the speed at which physical silver is being absorbed right now, and the demand did not pause after Monday. It did not wait for the system to catch up. It accelerated. Now let's talk about the sovereign mints, because this is where the situation goes, from dealers being sold out to the entire system being fundamentally compromised. See, when a dealer runs out of inventory, there is a path forward. They can restock. It is expensive, it is difficult, but there are wholesalers, private sellers, secondary markets, options exist. But when a sovereign mint, a government facility that actually manufactures the coins, when that facility shuts down or stops accepting new orders, there is no workaround. The coins simply do not exist. There is no alternative source. And right now, several of the most respected minting operations on the planet are either suspended or severely limited. Perth Mint in Australia is one of the most trusted precious metals minting facilities in the world. They produce coins traded globally. And according to confirmed reports, Perth Mint has fully suspended all silver sales. Not reduced output, not limited to certain products, fully suspended. Nothing is leaving that facility. The reason is not that they ran out of silver to mint. It is that they have so many orders already in the queue, orders placed weeks ago, that they cannot even fill those. They stopped taking new orders because they cannot keep up with the ones they already have. And Perth is not standing alone in this. The Royal Canadian Mint, the Royal Mint over in London, the Austrian Mint, the Japanese Mint, all of them are dealing with the same fundamental problem. Production capacity that has been completely overwhelmed by demand. All of them are running behind on existing orders. Several of them have either suspended new sales entirely or are severely limiting what they are willing to accept. The delivery timelines tell the story clearly. If you place an order today for a sovereign mint silver coin, you're looking at 8 to 10 weeks before it ships. 1 month ago, that same order would have taken 2 to 3 weeks, and that timeline is expected to get longer, not shorter, over the coming weeks. The American Silver Eagle deserves special attention here, because it is the single most popular retail silver coin in the entire world. People in this country have been buying silver eagles for generations. It is the go-to product, and right now, there are serious indications that the United States Mint is cutting the number of eagles it allocates to authorized dealers. In a normal month, dealers know roughly how many coins they're going to get. They can plan around that number. But the Mint has been signaling that dealers who were expecting a certain supply may end up receiving only a fraction of what was originally planned. And if that happens, the most popular silver product in the market becomes even scarcer than it already is. The United States Mint had already pulled the brakes before any of this happened. About 2 weeks prior, the Mint issued a notice saying rising silver prices were causing them to pause numismatic sales while they worked out new pricing. And in the short window before that pause took effect, buyers grabbed over 130,000 silver products, a level of demand not seen in nearly 2 decades of tracking. And that was before the crash, before Monday, before Tuesday. The demand has only gotten larger since. The Mint raised prices on certain products by 85%. That is not a dealer marking things up. That is the United States government adjusting its pricing because silver's actual market value moved so dramatically that their old numbers no longer reflected reality. So now, let's zoom way out. Because what is happening in the United States is not isolated. The demand explosion is happening on a global scale. And in some markets overseas, it is even more intense than what we are seeing here. Japan is a perfect example. Japan is one of the largest industrial economies on the planet. They need silver for manufacturing, for electronics, for automotive, for solar panel production. It is not optional for them. It is a core input. And the demand coming out of Japan right now has gone essentially vertical. There was a specific moment in early January that captured exactly how fast things are moving. One of the most respected refineries in the world has a retail website in Japan where buyers can purchase silver bars directly. On a Friday morning in early January, that website went live with a fresh batch of silver bar inventory. And the entire inventory disappeared in 30 minutes, not over the course of the day, not over a few hours. 30 minutes, half an hour, and everything they had in stock was gone. And that was almost a month before today. The demand has only increased since then. Singapore is another country where the situation on the ground has become impossible to ignore. State-owned media there has devoted extended coverage to silver bullion shortages. Dealers are reporting wait lists stretching from weeks into several months. One dealer reported orders for hundreds of kilograms of silver bars that will not arrive until March at the earliest. What used to take 1 to 2 weeks to deliver is now taking months. The supply chain has not just slowed, it has stalled. The reason Asian buyers are so aggressive, emptying inventories in minutes and accepting wait lists of months, has a lot to do with gold. Gold crossed $5,000 an ounce in January. And when you are sitting in Tokyo or Singapore and you see gold at $5,000 and silver somewhere in the 70s or 80s, silver looks extraordinarily cheap by comparison. The gold to silver ratio historically averages somewhere around 65 to 1. From that perspective, silver has significant room to close the gap. Asian buyers understand that math. They see the asymmetry. And they are acting on it with a speed and scale that Western markets are only beginning to grapple with. Then there is India. India became the largest importer of refined silver in the world in 2025. Nearly $10 billion worth, a massive jump over the previous year. And a significant portion of that silver was sourced from China and Hong Kong. Then China moved to lock down its silver exports, essentially cutting off India's biggest supplier. India needs silver for manufacturing, for jewelry, for solar, for electronics. It is woven into their economy. So India moved to secure supply through other channels. There was one order placed through the London market that was staggering in size, thousands of tons of silver in a single transaction. And the ripple effect hit the lease rate market instantly. Silver lease rates, which had been sitting at a fraction of a percent, spiked by an extraordinary multiple in a single day. because one country needed silver badly enough to place an order of that size, and the market did not have the depth to absorb it. And that is the scale of what is happening right now. This is not just retail investors buying a coin here and a bar there. This is governments. This is industrial buyers. This is sovereign demand measured in thousands of tons. And when that kind of demand hits a market with a relatively thin layer of available, deliverable physical inventory, the system does not bend. It breaks. Speaking of which, let's talk about the paper market, because there is a structural issue underneath all of this that most people who buy silver on a regular basis have never had to think about. For every single ounce of physical silver that actually exists in a form that can be delivered to a buyer, there are hundreds of ounces of paper claims floating around in the global financial system. Contracts, futures, ETF shares, derivatives, all of them representing ownership of silver that, in aggregate, far exceeds the amount that actually exists in deliverable storage. Under normal conditions, this does not matter. Because under normal conditions, nobody actually wants the physical silver. They want the price exposure. They want to watch the number move on their screen. People buy, people sell. Cash changes hands. The metal never moves. The system works because nobody's actually asking for the silver. But the moment that changes, the moment a meaningful number of people decide they actually want to hold physical silver in their hands, the math becomes very dangerous very fast. The paper promises vastly outnumber the physical ounces. The first people to ask for delivery get the metal. The rest get told to wait, or they get cash settled at whatever the paper price says silver is worth. And here is what made Tuesday what it was. Monday's crash showed investors in real time what happens when paper prices and physical prices disconnect. The spot price on the exchanges was showing one number. The price dealers were actually charging for a physical coin or bar was a completely different number, significantly higher. That disconnect was visible to anyone paying attention. And it forced a conclusion in a lot of minds at the same time. Paper is vulnerable, physical is not. People started converting fast, moving from ETF shares to physical coins, moving from unallocated accounts to allocated segregated storage, trying to get actual metal into their possession before the gap widened further. And every single one of them hit the same wall. Dealers sold out. Mints overwhelmed. Delivery times stretching into weeks and months. The system was not built to handle that kind of conversion volume. Now, I want to spend some time on the industrial side of this because it is arguably the most important piece of the puzzle for where silver goes from here. Not just this week, but over the next several years. Silver is not just a monetary metal. It is not just something people buy because they are nervous about the economy. Silver is a critical industrial input. It is used in solar panels, in electric vehicles, in artificial intelligence data centers, in semiconductors, in defense systems. And in most of these applications, there is no substitute. Silver is the most electrically conductive metal on the planet. Nothing else performs the way it does in these applications. That is not a marketing claim. That is physics. Solar panel manufacturing alone consumes an enormous amount of silver. Every panel requires a small amount, but when you multiply that by the billions of panels being manufactured globally every year, the total adds up to hundreds of millions of ounces annually. And global solar capacity is projected to grow dramatically over the next several years. If those projections hold, the silver consumed by solar panels alone is going to hit levels that dwarf where it is today. And that is just one application. Electric vehicles use more silver than conventional cars, significantly more, for electrical contacts, for battery components, for wiring. And EV production is growing fast, doubling its volume every few years. The combined silver demand from electric vehicles is already estimated in the tens of millions of ounces per year and climbing. And then there is artificial intelligence. Every AI model that gets trained, every query that gets processed, is happening on hardware that contains silver, in the connectors, in the circuit boards, in the cooling systems. AI infrastructure is the fastest growing sector in the global economy right now. Governments and corporations are pouring hundreds of billions of dollars into building it out, and every dollar spent translates directly into demand for silver. The thing that makes all of this so important is that these demands reinforce each other. AI needs power. The power is increasingly coming from solar and from nuclear. Solar manufacturing consumes silver. AI data centers need silver in their hardware. Electric vehicles need silver in their drivetrains. These industries are converging on the same metal at the same time. The result is what analysts are calling a lock-in effect. This is not cyclical demand that is going to spike and fall back down. This is structural. It is permanent. And it is growing faster than it has at any point in the history of silver. And on the supply side, here is the uncomfortable truth. Global silver mine production peaked years ago and has been gradually declining since. The gap between how much silver the world needs and how much is actually being pulled out of the ground has been running at a deficit for multiple years. That deficit has been filled by drawing down above ground inventories. Silver sitting in vaults, in storage facilities, in exchange warehouses, Over 1 billion ounces have been pulled out of available storage over the last several years to satisfy industrial demand and ETF backing requirements. 1 billion ounces. Gone. Consumed. Locked into products where recovering the silver would cost more than the silver itself is worth. It is not coming back. The corporate world is starting to understand this in a way that goes beyond simply buying silver on the open market. Samsung, one of the largest technology companies on the planet, finalized a deal in late 2025 to invest in restarting a silver mine. Not to buy silver on the spot market, not to purchase futures. They invested directly in a mine and secured an exclusive agreement to purchase 100% of the mine's output for 2 years. Exclusive. That is a technology giant deciding that the open market cannot be trusted to deliver what they need, so they secured their own source. If a company of that size is doing that, it tells you something very real about how tight the physical market actually is. If you have been following along and you are wondering how all of these threads connect, here is the short version. 60 days of building pressure on the physical supply chain, sovereign mints shutting down or falling behind on orders, industrial demand from solar, EVs, and AI all growing simultaneously and locked in for years, multiple years of supply deficits quietly drawing down the world's available silver, a paper market where claims on silver vastly exceed what can actually be delivered, and then a psychological trigger, the price crash, that brought millions of buyers into the market all at once, right on top of all of that. The result is what you saw on Monday and Tuesday. A system that had been holding together, barely, for weeks, finally reaching a point where it could not hold anymore. Now, if you are watching this and wondering what it means for you, whether you own silver or have been thinking about it, here is how to think about it. If you already hold physical silver, hold it. Do not sell because the paper price is showing you a number that looks lower than what you paid. The paper price and what dealers are actually paying for physical silver are two different things. When these disconnects resolve, they resolve in favor of the physical. The metal in your hands is worth what someone will actually pay you for it. And that number right now is significantly higher than what shows on a chart. If you have been thinking about buying but you have not pulled the trigger yet, the reality is that dealers are sold out and delivery times are long, 8 to 10 weeks in some cases for sovereign mint products. That is a hard pill to swallow. But here's the thing. If you wait another week, that timeline gets longer. If you wait another month, availability gets tighter. The people who place orders now, who get into the queue today, are going to be ahead of the people who decide to act next week or next month. And when physical supply is this constrained, being ahead matters. It matters a lot. If you are holding paper silver, whether that is an ETF, a futures position, or an unallocated account at a broker, you need to think seriously about what happens if the disconnect widens further. There are upcoming dates in the futures calendar, contract expiration dates, and first notice days, where the question of physical delivery becomes very real. If the system cannot deliver on those obligations, paper holders may end up getting cash settled at the paper price, while people holding physical metal are sitting on something worth meaningfully more. That is not a hypothetical. That is a mathematical possibility, given where things stand. The sovereign mints are the ones to watch going forward. Perth Mint suspending sales is a signal. A clear signal that the supply chain is broken not just at the retail level, but at the production level. If other major mints follow suit, if the Royal Canadian Mint or the Austrian Mint announce suspensions or severe allocation cuts, the situation escalates in a way that most market participants are not pricing in. If you have been paying attention to this story and it concerns you, good. It should. Drop a comment down below and tell me what you're seeing in your area. Are dealers in your region sold out too? Are you seeing wait times stretch out? I want to know what is happening on the ground where you live, because the national picture does not always capture what is happening at the local level. And if this breakdown was useful to you, share it. Seriously. Share it with someone you know who pays attention to precious metals or to the economy, because this is exactly the kind of story that mainstream financial coverage tends to gloss over. They will call it volatility. They will call it a correction. They will find someone to come on camera and tell you it is going to smooth itself out. But the structural issues underneath this, the deficit, the industrial demand, the sovereign mint shutdowns, the paper to physical ratio, none of those smooth themselves out in a week. They do not smooth themselves out in a month. They are baked into the system for years. Let me bring this back to the big picture, because it is important to end on the part that actually matters most. The 60-day buildup, the sovereign mint suspensions, the industrial demand lock-in, the multi-year supply deficit, China locking down its refining capacity, India scrambling, Japan emptying inventories in minutes, Samsung securing its own mine. All of these things were happening before Monday. Monday did not create the crisis. Monday was the moment when the cumulative weight of everything that had already been building finally became impossible to ignore. And that is the key distinction. A lot of people are going to hear about what happened on Monday and Tuesday and treat it like a one-time event, a spike, an anomaly, something that will settle down once the rush passes. But that is not what this is. The structural forces behind this surge, solar energy, electric vehicles, artificial intelligence, sovereign stockpiling, all of them are going to continue pressing on the physical silver market for years. Mine output is not going up in any meaningful way anytime soon. Above-ground inventories have already been drawn down by over 1 billion ounces. There is no lever to pull that suddenly produces more silver. What Tuesday represents is not a market correction that will bounce back. It is a structural shift. The relationship between supply and demand in the physical silver market has changed in a fundamental way. The dealers, the mints, the refineries, all of them are going to have to adjust to a reality where the old assumptions about how much silver is available and how quickly it can be delivered no longer hold. That adjustment is going to be uncomfortable. There are going to be days where the paper price and the physical price tell completely different stories. Weeks where you cannot find what you want at any price. And moments where the gap between what the market says silver is worth and what it actually costs to obtain an ounce becomes so wide that it forces a reckoning. We are at the very beginning of that reckoning. Tuesday was not the end of something, it was the start. And the people who understand that, the people who see what is happening underneath the surface and act on it, are going to be in a very different position than the people who wait until it is obvious on the front page of every newspaper. Because by the time it is on the front page, by the time every mainstream outlet is running silver as a headline story, the easy money will already be made. The physical will already be locked up. The wait times will already be months. The price will already be somewhere that makes Tuesday look like a bargain. So pay attention. Watch the mints, watch the lease rates, watch the delivery timelines, and watch what the industrial buyers are doing. Not what they are saying, but what they are actually doing with their money and their supply chains. Because they already know. They have known for a while. Tuesday just confirmed it for the rest of us. And if you are not subscribed to Element Axis, do it now. Because there is a lot more coming on this story. The situation is evolving fast, and we will be breaking it down as it develops. Like this video if it gave you something to think about. Subscribe if you have not already, and share it with someone who needs to hear it. We will see you in the next one.